one of the greatest inventions in terms of sort of financial engineering, one of the greatest innovations of all time is the sort of stock market and the publicly traded securities market.
That really is the issue. It's the level of risk people are in a position to take, both from a capacity standpoint and from a risk tolerance standpoint. Those are two different things.
In comes the media, okay, who figured out about 5 or 10 years ago that if they can scare you, then their programs actually become addictive.
Hello and welcome to the Unleash Your Retirement podcast with your host, David Corin. I'm Wendy McConnell. Hey, David, how you doing?
Outstanding, Wendy. How are you doing today?
You're always outstanding or fantastic. I mean, I love it.
Yeah, I love those words. You know, they're very descriptive and get me, going. So
Positivity.
That's right.
Yes, there you go. So we're going to have somebody else to influence positively today with some of your fabulous words. Would you like to introduce him?
Sure. I've asked Rick Wedell, who's the Chief Investment Officer at RFG Advisory, which is the RIA that we work with. I've asked him to join us today because he's also going to be here on the 29th of July for a special event here in our office and speaking live then to our clients and prospects and whoever wants to come. So we're pretty excited about having him out here. And I wanted to get him on to really talk about the markets and what people might expect from having him visit here, and also just share his background and give you some information on who Rick is and why it would be a good idea to come out and listen to him. So, Rick, you are the Chief Investment Officer and a leader of RFG's investments team there at RFG. You head up Bluemont. I was very impressed with your education and so forth when I first met you several years ago. Your background is pretty impressive. The Harvard magna cum laude and the Ford Scholar from Stanford. My understanding is correct on that Ford Scholar. Isn't that like being the valedictorian or something along those lines?
It is, yes. So if you achieved sort of the highest academic record in your MBA class, then they give you what's known as the Ford Scholarship, which is really funny. It's a plaque that is roughly the size of a paperweight. It is a very, very small piece of hardware. And in something that is also no joke, they engrave your name on a little plaque, one of these things that you would see like at a golf course with all the club champions or whatever else, that hangs directly outside the men's room in the Stanford Library. So it's quite an honor, but it's kind of funny.
Very, very impressive. And obviously you were part of the reason that I decided to affiliate with RFG several years ago. And it's been a great relationship so far. And I look forward to it continuing. And you also manage Bluemont, which is RFG's institutional level investment book of business, essentially, which we have access to and can take advantage of here for our clients. And of course, we've got a lot of stuff going on in the world right now that impacts markets. But I think the truth is that, when we really think about it, it's not necessarily when you think about investments, it's really about the client's investment risk, what they're trying to accomplish, what their goals are. It's not really about what the market's doing, because you need to be positioned in such a way that you can handle whatever the market does based on your risk profile and what you're trying to accomplish. So why don't we start there and talk about that a little bit, Rick? Because how do you guys do that at Bluemont?
No, absolutely. And I think it really starts with an understanding that there is a difference between a wealth management chief investment officer versus, let's say, the chief investment officer at a hedge fund, or maybe even the chief investment officer at like a mutual fund or something else like that. They are different roles. And actually, if you think about a wealth management chief investment officer, it comes back directly to what you were talking about, David, which is You're managing money generally for people who are in retirement. Or approaching retirement, you're managing sort of life cycle savings, right? So these are funds that have sort of distinct phases, right? We have an accumulation phase, we have a distribution phase. We even, we don't like to necessarily talk about this, but we have to. We have like a termination phase, right? Of, what happens to your estate after you're gone. And depending on where a client is, they may have a lot of different goals for that, right? So, classic, asset allocation theory might tell us, hey, when you're in your sort of accumulation phase, when you're saving for retirement, you want to be risky. When you're distributing out, and you're in retirement, you actually want to be more conservative because volatility is actually more important than your overall level of return. A lot of people don't understand this, but when you're taking a distribution out of a portfolio, stability is more important than rah-rah, go get 'em numbers. And then, depending on how large that portfolio is, sometimes we like to think that, actually the people who own the assets aren't really managing them on their own behalf. They're actually managing them on behalf of the people who stand to inherit them post, the termination of post death, if you will.
Yep.
And that could be kids, that could be a charity, et cetera. But then you start to think about, goals flipping a little bit because, the goals of your, 30, 40-year-old kids don't necessarily match the goals of, the 70-year-old that's, investing on their behalf. And so there's a lot that goes into that.
Right.
But one of the most important things is the understanding of what is this money being used for, right? So, if you're a hedge fund CIO, you're like, look, I just want the biggest return I can possibly get, right? And I want to make sure that, when I put my IRR numbers or my return numbers out there, that I can then go out there and recruit, and bring in new assets to the platform and, let's go. If you think about, more of a wealth management context, it's a lot less about, what's my absolute return level, and a lot more about, okay, how does this path look for the retirees that are in the portfolio? What's the return relative to the amount of risk that I'm taking? How do I try and deliver the maximum amount of return that I can while reducing volatility in the portfolio? And that's what we're really focused on at Bluemont is, it's all about, it's not just about, okay, how much did you beat the S&P 500 this year or this and that and the other. It's actually how much risk did you take while you were doing it that matters more for most people than the actual level of return.
Correct. And that really is the issue. It's the level of risk people are in a position to take, both from a capacity standpoint and from a risk tolerance standpoint, because those are two different things. Somebody can have a really great risk tolerance, I want to be all in the market, but the truth is they really don't have that capacity. Because they're taking money out, and we can't, we need to keep safe assets in the portfolio to provide for those withdrawal needs over the years. So something we talk about a lot with clients is, where do we need to be on the risk capacity scale versus your risk tolerance? And then we have other folks that are very risk averse but have great risk capacity. So, then we can talk to them about, well, a lot of these assets, you're not going to use. So why don't we be a little more aggressive for your future, for the people that will inherit later on, so you have, a bigger cushion later on. And that's always a conversation that we have to get in with clients and help them through and figure out through that process.
Yep.
And, we're primarily investing in the public market, the S&P 500, the NASDAQ, et cetera, traded equities. We're not doing much in the private market, the private equity market, which is different. And I know you have history at Bain Capital, which I believe, didn't Mitt Romney work with them or something?
That is correct. He was mostly gone by the time I joined Bain Capital back in 2001. And Mitt had mostly at that point moved on. He still had an office, but I think I maybe once saw him in the hallways, not because I wasn't there all the time. Believe me, when you work that kind of job, you are literally there all the time. But more because Mitt had kind of moved on to bigger and better things. I believe at the time it was either something to do with the Salt Lake Olympics or something else like that he had sort of moved off into the background with. Yeah. But Bain Capital is kind of famous for being Mitt Romney's firm.
Yeah, and they're a private equity firm, if I'm not mistaken. That's what they primarily do. Can you explain for folks what the difference is between the public stock market and the private equity market? That we have ways to invest there. That's true, but what are the differences? Because it's larger. The private equity market is much larger than the public market. And people don't realize that.
That is correct. If you think about public equity securities, and I'll just sort of let's start by defining what the public market is, and then we can go and think about, because that's more familiar, and then we can think about what sort of private markets are, right? So, if I think about it, one of the greatest inventions in terms of sort of financial engineering, one of the greatest innovations of all time is the sort of stock market and the publicly traded securities market, right? Because what it effectively allowed companies to do, which really didn't exist prior to the creation of stocks and bonds, it allowed companies to go out there and basically democratize the ownership process, right? So instead of one or two or three people owning a company like Delta Airlines, instead you could divide the ownership up of Delta Airlines into a million different pieces and allow different investors to purchase different shares. And then that allows for diversification, right? So, I don't have to just own one company. I can own a bunch of different companies. And if I create sort of a market, which we did, that's very, very efficient, I can sort of buy and sell those securities, within seconds, if I choose to, right? Over the course of that financial innovation, there were some stumbles and trips and falls, right? If we think about the 1910s, the 1920s, the 1930s, there were some things that we learned along the way. And so you had some entities step in to start to regulate those markets, most notably the SEC, that came in and said, okay, here's what you can do, here's what you can't do, here's the sort of disclosure requirements that you need to do if you're going to offer one of these securities out in the marketplace. All of these things to sort of provide information to the public, which is really what the SEC does. They provide information to the public, or ensure that companies provide us information to the public about the securities that are being purchased. And what that really does is it allows the sort of democratization of ownership of, the companies that are out there that choose to engage in the public markets, right? So you and I and the retirees and everybody else like that can own little tiny pieces of this. And even if you're an investor that only has, $50,000 or, $100,000, you can go out there and buy this big, broad swath of the economy. That's been, if you think about the history of the stock market, it's really been one of the most fantastic wealth creation engines for people that are at that sort of level of all time, right? I mean, it truly is, if you think about it, remarkable how beneficial that has been.
Right.
So now you look at the private markets, right? And the private markets look at it and say like, I'm not necessarily sure I need to do all of that democratization stuff, right? I would prefer to be owned by a few companies. I would prefer to be owned privately so that I don't have to jump through all the hurdles that the SEC puts out there in terms of all of this disclosure requirements. I don't want to necessarily host quarterly, calls with all the investors that are out there and host an annual shareholders meeting, et cetera. I would rather be owned by a company like Bain Capital, where they have investors that have invested at Bain Capital, and they go out and they buy companies that you've heard of, right? So, like for example, Dunkin' Donuts for a long time was owned by Bain Capital. These are companies that are large names that you interact with every day, that are owned by private equity companies. They're privately owned. And when you invest in one of these types of vehicles, basically what you do is you write a check to a company like a Bain Capital, or like an Apollo, or like a Blackstone, or one of the others that are out there, all the different Oaks. There's a bunch of different private investment vehicles that are out there. And you give that company your money, and that company then goes and buys a portfolio of companies with that money, and that's your sort of investment portfolio for those private equity investments.
Right.
Couple of things to understand about that. One, it's a lot less liquid than the public markets. So that can be a good thing and a bad thing. On the one hand, the public markets, we can just see, had this kind of like, if you think about April, the value of those investments dropped 20%, and then it rose by 20% on the other side in the span of about, a 3-month time frame. And you don't generally get that with private equity investments because there's not a publicly traded market for them. So a lot of people would argue that those valuations tend to be a little bit more stable over time. You don't see the ups and downs jumps because they're privately held and privately marked. And so you really only get a mark when either the company is bought or sold. And the private equity companies do sort of an estimated valuation along the way, but it's a lot less volatile than your public equity securities.
Right.
The flip side is it's also a lot less liquid. So typically for a private equity investment, you're going to put some money to work, and you will be invested in that. You may put it in all at once. You may say, hey, I'm going to commit to this fund, and then they call you, every couple of months over the course of 4 or 5 years and ask for, some of your commitment money from you. And then they pay you out over the course of the next, 5, 6, 7 years. And so it tends to be sort of locked up money in its most pure form. And I will just tell you, I left Bain Capital back in 2016, so 9 years ago. And about 3 days ago, I got a notice from them that they wanted a check for, a couple $100 for an investment that I had made back in 2015 that is still calling capital to this day.
Oh, wow.
And, I still occasionally get distribution checks from them from investments that I made when I worked there. So just be aware when you go into one of these private equity vehicles that liquidity, right? This really is, for the most part, for people that, are looking to invest that legacy, are looking for a stable portion of their portfolio, but understand that it may be a decade or more before they're actually finished with moving into or out of one of these funds. And so you have to be, for private equity in its traditional sense, to be appropriate for you, you have to be able to say, yep, this is money that I know I'm not going to need for the next 10 years. And I will just tell you, 10 years is a long time, right? So it is one of these things. It's interesting because in theory you can get, sort of uncorrelated returns versus the rest of the market, or less volatile returns for versus the rest of the market. There's some arguments out there that say that, companies, when they're beholden to public shareholders, they tend to manage one quarter at a time, whereas private equity companies can really take their eyes and focus on, where are we going to be 4 or 5 years from now, and that enables them to invest in different ways. It really is kind of a different market. But I will say that access to it really is one of these where you've got to be thinking about your liquidity picture and whether or not that's really appropriate for you or not.
Absolutely. That liquidity issue is a big deal. You get locked into these things for long periods of time. If the returns can be very nice if you're willing to let the money ride. And that's if you've got a portion of your portfolio that you can set aside like that, which we do. We're willing to put people in that if that's what they want, and also they understand the liquidity issue, because it does take a long time for that stuff to come to get that money back, and it's not easy. If you want to come out of it, it takes time. It's not something that you can just go to the market and click a button and sell like we can with all the other equities that we work with that are fully liquid in the public side. So, but I did want to raise that because you have that background, and it's important, I think, for people to understand the difference. Private equity versus public, because it's a big deal, and it's something to be aware of for folks out there and for clients out there. You do a regular investment update that I share with clients, and that goes out. I was doing those before we joined RFG. Now I just let you do it because you do a great job. So we put that out there regularly to clients to see. So I have a feeling a lot of my clients, when they see this, will say, "Oh, we know him," and he actually knows David. Look, he's on his podcast. So talk a little bit about that and what you try to do with those regular updates, because what's really nice is they're very timely, based on things that happen. The tariffs, that kind of stuff occurring when the markets are especially in turmoil. That's when we tend to hear from you a lot, which is wonderful. And it can be very reassuring to clients to understand what's going on and why, and those impacts. So, and that's something you do regularly. And that's something we'll be doing in July as well. And, don't want to get into too much of what's going on right now, because it'll be different in July. It's so moving constantly. A few months ago, we wouldn't have been talking about a war between Iran and Israel. Now we are. The war in Ukraine is still ongoing. We've got a lot of stuff, in terms of the FOMC meeting today. What are they going to do with interest rates? So there's all these things that are constantly changing. So we love to keep clients aware of what's going on and up to speed. And so why don't you tell me a little bit about how you're thinking, your process when you put out an update, and why you do that? I mean, they are pretty regular.
Absolutely. And I think, part of this is that let's talk about the reason why. Like, why would you put out an update? Okay. And it's a little selfish, if you will, but I think it provides great value to clients. So I just want to explain a little bit of psychology here. Okay. Fear sells stuff. Okay. And when you think about, fear is actually addictive. Most people don't realize this, but if you Google it, like go to your web browser and Google, is fear addictive? You will get back a host of, interesting research that comes back and says, yes, actually, when you get scared, when you get angry, when you get frightened, your brain releases these chemicals that trigger that sort of fear and anger response. And I realize I'm diving down the rabbit hole here, but trust me, I'll bring it all back. You generate that sort of fear and anger response. And that fear and anger response actually releases a chemical in your brain, sort of serotonin, dopamine, et cetera, that is received in a certain way to make you feel sort of scared and angry. But it is addictive in and of itself. And we get people that are kind of addicted to fear, right? Like they like to feel that way. And a lot of people look at me at this point and say, like, what do you mean you can't be addicted to anger? And I'm like, who those people are, right? Like, in your own life, you meet people that are like, they're always angry about something. And it's not their fault. They're actually addicted to anger, believe it or not. That's a chemical dependency that they have. Okay. Now, in comes the media. Okay, who figured out about 5 or 10 years ago that if they can scare you, then their programs actually become addictive. Okay, so, if you tune into, politics is the worst at this, right? Like you tune into Fox News, you tune into CNN, they're both equally terrible. And all they're trying to do is get you angry, right? Like, because if they get you angry, you get all fired up about it. And then you tune in the next day to get your anger fix again. Like, that's the way that works. And by the way, CNBC and Fox Business and the financial press are exactly the same way, right? Like they are not in the business of providing you with relevant information about the markets. They are in the business of selling advertising. That's what they do. Okay. So when Jim Cramer, who, by the way, I am on record as saying there's a special place in hell reserved for that guy. Okay. When he gets on the screen and starts telling you all about this, like buy, sell, here's what's going on. You need to react and jump. He's selling fear in two different ways. When the market's going down, he sells fear that like, hey, you need to get out of this or you need to be scared or concerned. And when the market's going up, he sells a different kind of fear. It's called fear of missing out, FOMO, right? And so either way, what they are doing is convincing you that you always need to be stressed out one way or another. Either the market's going up or the market's going down. And if you look at this, right, like there's actually a headline that we do in some of our presentations where, you know, you just look at the headline that came through across Fox Business, because we can pick on them too, you know, about like how the Dow was having its worst day of the year. And it was a day in like February. And so it was the worst day of the year, but it was because the year was only like less than 2 months old, right?
Right.
And the graphic that they put up there was just like, I mean, it looked like the Fed was on fire. There's this like red line going down and everything else like that. If you back out the chart, the Dow over the last 12 months was up like 16, 17% and was having a day when it traded off like 0.5%, right? And so you're like, look, like this was not designed to be informative. This was designed to scare you so that you would read the article, see the advertisements, they would get paid, okay? And here's where the selfish part comes in. That fear is actually not good for our clients.
Right.
So if our clients are getting their sole source of market information from the likes of CNBC or Fox Business or any one of these other people whose sole motivation is to scare you, right? Like that's the only thing they're trying to do is to freak you out, right? So that you tune in again tomorrow.
And they're very good at it.
Then we deal with a whole lot of terrified clients all the time. Right? And I don't want to deal with terrified clients, right? Like you don't want to deal with terrified clients. Our clients actually would prefer not to be terrified. And so when we started the sort of market commentaries and market updates, the whole idea was let's actually educate people from, you know, in terms of what's going on in the marketplace, what you should be thinking about it, you know, hey, it's actually better if you're not freaked out about what's going on a daily basis, that's not actually the way that you want to manage your portfolio. And let's bring that information to people in a way that they can consume it on a timely basis and maybe wean them off a little bit of the Jim Cramers of the world that are constantly trying to stress people out and freak people out, right? Like, you know, the market is actually a much, you know, if you're not panicked by it all the time, it's actually a relatively benign and predictable experience depending on what your risk tolerance is and what type of investment portfolio you're invested in. And so we created the market updates as kind of a way to give people information about what's going on in the marketplace, give them a view into how we should be thinking about trading in a non-sensationalized way, to let you know that, yeah, we're on top of things. We know what's going on out there. And I will just say, we do get the feedback because I know I'm coming out there in July to do sort of a, you know, a sort of a dinner event or an event, basically.
Right. It's an event.
And I will just say that I frequently get the feedback from people who watch the market commentary that then come to the events that are like, wow, in the market commentary, you're kind of very laid back and subdued. And in the events, this was not the, you know, this is a different sort of high energy, fired up Rick versus what we normally see in the market commentary. And I will just tell you that that is a little bit by design, right? Like, on the one hand, on the market commentary, like I'm actually not trying to get people fired up. I'm trying to make sure that everybody understands what's out there in a calm manner. If you get me up on my soapbox in the event come July, you'll see me get a lot more emotional and animated and passionate about things, but probably not exactly what you think. I'm more likely to get passionate about how Jim Cramer is evil than I am to get passionate about what's going on with the Fed. So there you go.
We are excited that you're going to be out here on the 29th. We've got, this is one of our little invitation cards out there that talks about the event. It's July 29th, 6 o'clock, and we will have food and drink, and we'll be merry, and then we'll get together and let Rick talk about current trends, and then answer questions for folks that have questions that they need to get answered or feel that they would like to. It really is an opportunity to hear from somebody that really, really knows what's going on out there in the markets, has been doing this a long time. And I think you got a little feel for that today in the podcast. We sort of touched on some of the things that Rick is into and aware of and on top of. And you work with other advisors all across the country, so you do these events regularly, and you're getting client feedback all the time. So you sort of have a handle on the kind of questions you're going to get. So and what people are concerned about. So I'm excited for the event out on the 29th. I'm looking forward to it. I'm looking forward to having you here. And we're all at the office sort of excited about it and looking forward to it. So anyway, I wanted to have you on today and have this opportunity to sort of let people get a feel for you, through the podcast. And hopefully this is, again, it's educational. We covered some interesting topics, today. The whole difference between public and private markets, I think, fascinating for a lot of folks. And now, and also, how you balance portfolios out and why you do look at risk capacity and risk tolerance levels. And that's what really drives how you invest and how you want to be invested. So appreciate you coming on today, Rick. Wendy, do you have any questions for Rick that you want to raise, or?
Rick, do you want to give out a number or website that people can get in touch with you if they have more questions?
Absolutely. The easiest place to get in touch with me is actually through David, believe it or not, because he has the sort of direct line to me. But if you are looking for information about how we sort of manage investments or anything else like that, you can go to www.bluemonte, that's BLUEMONTE.com. And you'll actually see there some videos and some other stuff like that, and the rest of the team that support us here. But the easiest way to get in touch with me is through David, because we always like to make sure that your advisor is aware of any conversations that you might be having with an investment manager.
Right. And you can go on our website, rvawealthmanagement.com. And you can sign up for the event on the 29th because we have the sign in under our events tab. So it's already set up. And if you're interested, please go in and sign up. We'd love to see you on the 29th. And we really appreciate you guys listening. And Rick, thanks again for being on the show. I really appreciate it.
Well, David, thank you so much for having me. And I'm looking forward to seeing you here in a couple of weeks.
Outstanding.
All right, guys. Thanks to both of you, and thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.